Okay, this one is chapter 5, number 26, and it actually has some equipment in it. So on January 1st, 2018, Sledge had common stock of 120. So I just honestly don't know if I need it or not, so I wrote it down. So balance 1118. Usually they tell us the purchase price, but this is 1118, so I'm a little confused at the moment. And retained earnings of 260. During the year, they reported sales of 130, cost of goods sold 70, and operating expenses 40. So I wrote all that down. On January 1st, 2016, I acquired 80% of Sledge's outstanding voting stock. At that date, $60,000 of the acquisition date fair value was assigned to unrecorded contracts. So I try to do a purchase price allocation, but again, the only reason I do a purchase price allocation is to figure out the assets and goodwill, and it is telling me how much is going there, but that's very important to get the 1116. So at that date, $60,000, the acquisition fair value was assigned to unrecorded contracts. So I've got contracts here at $60,000 with a 20-year life. So I divide by 20. I have $3,000 of amortization, and $20,000 to a building with a 10-year life. So I have $20,000 divided by 10 is $2,000. Okay. So it doesn't say anything about goodwill, so I'll assume that that's all of it. So I have my amortization, and I am doing a consolidated worksheet out of December 31st, 2018. So I bring the balance forward to January 1st, 2018. So I need 2016, 2017. That's $6,000 of amortization and $4,000 of depreciation. So $60,000 minus 6 is 54. The $20,000 minus 2 years of depreciation, it leaves me $16,000 left on the building. Okay, so this is for worksheet entry number 2, because I need to bring the assets forward to the beginning of 2018, and they've been amortized 2 years, so 2 years of this number is gone. Okay. Inventory in 2017, so I have my 2017 inventory. Inventory costing $9,000 was sold to Sledge for $15,000. So if it was sold to Sledge for $15,000 and it cost me $9,000, my gain is $6,000 out of the $15,000. Of this merchandise, Percy continued to hold $5,000 at year end. So I multiply it by 5,000, I get $2,000. Okay. So notice this is Sledge sold it to Percy, so it's upstream. In 2018. Inventory costing $11,000. They sold it for $20,000, so that's a $9,000 gain. So 9,000 divided by 20, and they still held half of the items at year end. So Percy bought it for $20,000, so half of that is left. So 10. So 9 divided by 20 times 10 is 45,000. So if I was going to circle these, I would circle the 2,000, the 4,500, and the 2,000, 20,000 right there. But I wrote that again. So basically we have this number, and those number. Okay? If you feel better about it, go ahead and make your journal entries. Debit sales, credit cost of goods sold, debit cost of goods sold, credit inventory, debit upstream, so retained earnings and credit cost of goods sold. But we'll get to those in a second. Okay? The last one is my inventory. Okay, so I'm sorry, my equipment on January 1st, 2017. That date is important. Notice it wasn't 2016 the day I bought it. It was 1/1/2017. They sold equipment to Sledge for $12,000. It originally cost $16,000, so the equipment should be $16,000, but it is $12,000. Had a book value of $9,000. Okay, so basically my selling price is $16,000. It had a book value of $9,000, so my accumulated depreciation I can back into of $7,000. My selling price was $12,000, so I sold it for $12,000, and it had a book value of $9,000, so I have a $3,000 gain. All right, so it has a 5-year life, so I take my $12,000 divided by 5, get $2,400. My 9,000 book value, that's what it was. Divided by 5 is 18. And my gain divided by 5 is 6. You don't have to do that one. But notice that 2,400 minus 1,800. This is the depreciation they are currently taking because the buyer has it on their books for 2,400. And this one is what it should have been if they'd kept it. Okay? So equipment is 12. It should be 16 right here. They sold it for 12. It should be 16, so that difference is 4. Accumulated depreciation is now 0. It should be 7. Right here. I had to back into that number. So that difference is 7. And so if the gain is 3, it should be 0, so that difference is 3. Okay. However, and depreciation expense is 2,400. It should be 1,800, and that difference is 6. Okay. However, it was done on 1/1/17, and I need to bring it forward 1 year. So these two numbers are going to come down by 600 a year. You don't necessarily have to fill in these parentheses. I just am showing you that after 1 year, they've taken $2,400 of depreciation. I should have taken 18, so 7,000 plus 18 is 8,800. But quite frankly, these two simply go down by the amount of depreciation. The gain was 3,000, but notice depreciation is also off by 600. And I've taken too much depreciation, so I had too much revenue and too much expense. Okay, so if my too much expense was $600 and my too much revenue was 3,000, the net effect of that after 1 year is 2,400 left. So this gain is no longer in gain. Okay, I could say it's in retained earnings, but since it's downstream, I'm going to take it to the investment account. Okay, so if you feel like just making the journal entry for year 1, a lot of people have done that in the past. They actually write down the journal entry for year 1, and then they count the number of years they need to bring it forward, cross off the $7,000 and $3,000 and do that. Okay, so the last thing I want to do is the equity income computation. Says they've properly applied the equity method to the investment in Sledge. I need to find one that you don't use the full equity method. Okay, so I take my subs net income. Hopefully that's already told to it. Oh, I had to compute that up above. Okay, so subs net income, I had, obviously, hopefully you didn't add the common stock and retained earnings, but I didn't do that very well. Can I show that? Okay. So revenues minus expenses, 130,000 minus 70 minus 40 is net income of 20. Okay, need to clear that, sorry. All right, so my subs net income is 20,000 minus amortization of 5. I did that up here. Then I adjust for upstream items. My inventory is upstream because it's Sledge sold it to Percy, and then the equipment is downstream because Percy sold it to Sledge. Okay, so I do my upstream items first, take out my 2018 gain, add back in my 2017 gain, take it times my ownership percentages at this point. So I take my 12, 5, 15 minus 45 plus 2 is 12, 5. Take it times 80 or 20, and so this one is that. Okay, then I take my downstream. Notice that I don't subtract my gain on the equipment because I'm in 2018 for this equity income computation, and this happened in 2017. But I do have my excess depreciation still, so I need to add it back. So remember, they subtracted 2,400. They should have subtracted 1,800, so I have to add it back. Last year, I would have subtracted 3,000 and added back 600. And the next year I add back 600. The next year, actually I add back 600 for 5 years. Okay. All right, so my equity income is $10,000. Whoops, $10,600. Okay. All right, and dividends are 0 in this one. So, the first thing I do is I eliminate the subs owner's equity. Okay. Go back to here. I have two. These are my balances on 1/1/18. Okay. So they're giving me the 1/1/18 balances. I don't have to look up or back into anything. So 120 and 260. All right. I'm right here. 120,000 for common stock. The 260,000. I'm simply going to, let me actually make this bigger. The retained earnings, I'm simply going to write right there for the meantime and leave these numbers blank. Okay, so I'm not going to have these three numbers there. I'm going to adjust my assets to fair market value. Hopefully you have them written, this paper in front of you, or you have written all this down. If you haven't written it down, you're wasting your time. You have to write this down in practice. So 54,000, 16,000 against 80 goes to the investment, non-controlling interest is 20. Equity income computation, we did it up there. 10,600, okay, and my non-controlling interest is 2,500. So I debit equity income for 10,600 and credit the investment, and my non-controlling interest is 2,500. Next one, I eliminate dividends, but there were no dividends, so I don't have to do anything there. I have my buildings and amortization. You can look above. There's your journal entry for that. My three inventory entries were 20,000 for 2018, 4,500 for 2018, and 2,000 for 2018. So sales and cost of goods sold, get the inventory down, 4,500 to cost of goods sold. It was upstream, so I debit retained earnings. Now I need to go back up here and say, okay, minus $2,000 for retained earnings. I'm not going to put this number there yet because I've got equipment left to go. Okay, so now I'm going to go to my equipment. And if you notice up here, again, you've got it in front of you, so I don't want to keep scrolling there, but the difference is 4,000, 6,400, and 2,400, and 600, okay? So I need to get the equipment up by 4,000. I need to get my accumulated depreciation down by 6,400. Okay, that gain is no longer a gain. We always say it's buried in retained earnings, but since this is downstream and the full equity method, I take it to investment. The reason I take it to investment is because my retained earnings is already correct because I took it out in 2017. I took that gain out. So my equity income that's booked on the parents' books is already making allowances for that. Okay, investment, downstream, full equity method only. And then I get rid of my depreciation expense and accumulated depreciation. Okay, if this had been upstream, this would have been retained earnings instead of the investment. Okay, and I would have subtracted an additional 2,400 from this, okay? But now that I'm done with all this, I go back up here and finish this, and I have 258, and I take 80/20, and we are done.